Iran offered to reopen the Strait of Hormuz if the U.S. lifts its blockade and the war ends, while setting aside nuclear negotiations for later. Trump has been firm on not lifting the blockade until a deal with Iran is 100% complete. Hence, Iran postponing negotiations on nuclear ambitions made the final negotiation outcome unclear. Next, the two were supposed to meet again in Pakistan for the second round of peace talk, but Trump canceled that and commented that too much time wasted on traveling. President Trump was evacuated from the White House Correspondents' Dinner after multiple gunshots were heard in the ballroom. One officer was shot, but was saved by his bulletproof vest. The suspected shooter was identified later as Cole Allen, 31 years old, of Torrance, California. Numerous other top Trump administration officials were at the event, including Vice President J.D. Vance, FBI Director Kash Patel, and Health and Human Services Secretary Robert F. Kennedy, Jr. About 30% of the companies have reported. The final result is anticipated to finalize by mid-May 2026. The blended net profit margin for Q1 2026 is 13.4%. Looking all the way back to 2009, the current record is 13.2%, which occurred last quarter, 2025 Q4. While this isn't the full report, one thing to highlight is even with the disruption at Strait of Hormuz and the war, most S&P 500 companies still perform relatively well. Analysts believe net profit margins will be even higher for the rest of this year. As of today, this year's estimated net profit margin for Q2 is 14.1%, Q3 14.6%, and Q4 14.6%. You can see that tech is still going well, financials too, and the rest that are mostly stable throughout will be utilities, industrials, and materials. And for real estate, it'll experience a little bit of a drop. Makes sense because of higher inflation eroding the overall yield, and then materials are more expensive for real estate. At the end of 2025, Germany's economy finally seemed to be escaping its endless stagnation. Q4 year-on-year growth came in at 0.4%. Industrial orders were rose, and the billions in defense and infrastructure investment painted an optimistic picture until the war in the Middle East started. The IFO index, which is Germany's most prominent leading indicator, took another plunge in April. That's the lowest level since the pandemic. Germany is one of Europe's largest net importers of energy, and it doesn't help that impact from the war shifted from price shock to actual energy supply and broader supply chain shock, putting Germany at the center of an exogenous global disruption, again like 2022. Inflation is already in full swing, stressing transportation, food, and products that need oil, and not all companies can immediately pass on the higher costs to consumers due to contract obligations. And one more pessimistic notch down, gas reserves are currently at their lowest level at this time of the year in 5 years. The government has two broad challenges: providing short-term relief from high energy prices and pressing ahead with longer-term structural reforms. The recent policy debate heated up again on decision to temporarily cut fuel taxes and introduce a controversial €1,000 tax-free bonus that employers may, but not required to, pay their employees. For longer-term structural reforms, the current focus is on healthcare and pension reform to aid public finances. There have been many proposals, but still very few actual decisions. And next, the planned investments in defense and infrastructure, the billions of dollars to be invested in this area, should support Germany's economy this year. The chart at the right briefly shows the tentative plans, the transports, hospitals, and obviously energy. Digitalization also. March industrial profits jumped 15.8% year-on-year, the fastest pace in 6 months. Even as the Middle East war upended global oil markets and sent raw material costs soaring, and industrials already grew 15.2% year-on-year in January and February combined. China tends to view January and February together to smoothen any outlier from the holiday season. National Bureau of Statistics of China commented that the overall growth was largely driven by the soar in profits in equipment and high-tech manufacturing sectors, 21% and 47.4% respectively. AI and semiconductor saw outsized profit growth in Q1. Optical fiber makers' profits surged 336.8% year-on-year. Optoelectronics and display devices also posted gains. Emerging industries also benefited from the strong demand for intelligent products. Profits of drone manufacturers and other intelligent consumer device makers gained. Raw material producers and oil refineries also saw gains. Strategic emerging industries, such as aerospace, new energy, and next-generation information technology, benefited too. This improved profitability was in part underpinned by robust exports, which grew 14.7% year-on-year. The Middle East conflict will nonetheless weigh on the economy in the second quarter. Higher energy prices and weakening external demand will face headwind. Lastly, Trump administration recently imposed sanctions on China's Hengli Petrochemical Dalian refinery. It's one of Iran's largest customers of crude oil and petroleum products. The department's Office of Foreign Assets Control also imposed sanctions on about 40 shipping companies and vessels that operate as part of Iran's shadow fleet. Japan's March inflation intensified despite the government's efforts to help consumers. Headline CPI inflation rose 1.5% year-on-year and core inflation at 1.8% year-on-year. With core inflation higher than headline, shows that prices without food and energy are higher, reflecting increased pressure from goods and services. Both increased 0.6% and 0.2% respectively. Both rising global energy prices and weak Japanese yen should add more pressure on domestic prices. Producer and import prices both increased quite sharply. Next, wage growth negotiations should put overall salaries growth above 5%, which means businesses are likely to pass these input cost hikes to consumers. Next, on interest rates, markets widely expect Bank of Japan to stay on hold in April with a higher chance of a hike in June. On the bright side, recent data suggests that energy shocks are having a more prolonged and much larger impact on inflation than on growth. The 8 parameters on the right support that view. Q4 GDP was stable. Services and manufacturing PMIs are still in expansionary zone. Exports remained strong. Business sentiment stayed positive, and so on.